And in this episode, what we're going to be talking about is flipping real estate in your business. You know, whether or not you're using LLCs, corporations. I'm going to break it all down for you and talk about how you should approach flipping, the concerns that you may have, the things that you need to look out for, and some different strategies. Maybe you haven't thought of these strategies before in using a particular type of entity. So I've got about 45 minutes of content ready for you all to dive into this. Remember, if you have questions, you can ask those questions as well. I do have the ability to monitor those, so they do come in. I'll try to respond to as many questions as I can as we proceed forward. All right. So what is it with regards to flipping? Why is it such a concern? And you need to know about asset protection. Well, here's the thing. If you're going to flip real estate, the number one concern you have is that you don't want to be tagged as a dealer, right? Liabilities out there as well, but you don't want to get tagged as a dealer, because if you're tagged as a dealer, and that is someone who regularly buys and sells real estate, right? They treat it as inventory. You're not buying it to hold as a long-term investor. Then there are some adverse tax consequences that follow being tagged as a dealer. Namely, those adverse tax consequences are this. Everything you make is considered active income because, hey, you're flipping property, that's your job. On top of that, you can't engage in 1031 exchanges. They will not allow you, that is the IRS, the tax code doesn't allow you to participate in 1031 exchanges on your real estate because it's considered inventory and it's not eligible. To be eligible for 1031, you need to be an investor. The other problems you have when it comes to being tagged as a dealer is you can't depreciate your property. So all of that's going to go away. Those great benefits of having real estate and offsetting it against your income, that's no longer going to be there for you. If you engage in installment sales, which I have a lot of clients in certain markets who will flip real estate and they'll sell it on a contract to an investor, a homeowner. And what happens is that they sell them a house, let's say it's for $100,000, and they collect $10,000 up front and $1,500 a month. Well, when they sell that property, if their profit in that entire deal, let's say it was going to be 50 grand, they're going to pay tax on that entire amount, that entire $50,000. They have to pay tax on it, even though they only received $10,000 down in that $1,500 a month. Why? Because you're not eligible for installment sales if you're treated as a dealer. So I hope I've laid out enough reasons why you don't want to flip in your own name and you don't want to flip through an entity that passes down to you that is disregarded. For example, if you set up a limited liability company here and you treat it as a disregarded LLC or a partnership for tax purposes, and you're down here as the member in that LLC, well, the issue is going to be that anything that takes place in the LLC is going to take place in your name for tax purposes. So if the LLC is a dealer, you're a dealer if you have these two tax statuses in effect for that company. So what we have to do then is plan. We want to make sure that we're covering ourselves on the tax side, so we're not going to be tagged as a dealer. Dealer means bad. But we also want to look at the liabilities aspect of this as well. We don't want a buyer of one of our properties to cause massive disruptions in our flipping business and go out there and torch us on social media and make it so that people don't want to buy homes from us because they think they're going to get a bad deal. And it's not that this buyer got a bad deal. Maybe the buyer's just not happy with the deal after they close and they're looking for some retribution and they're going to go back against you. So we have to ensure that aspect, that is being protected, that liability protection's there, so that people that we're selling the houses to cannot come back at a later date and cause disruptions in our business. So that's a whole other aspect of the planning that we need to layer on here. So what is the base structure? What do we typically look at when we're working with someone who's going to flip real estate? I'm going to first look at the tax side. And so I'm going to create an entity for a flipper. This is going to be either a limited liability company or a traditional corporation, an Inc. It can be either one. But what's key here is that when you set up this entity, you want to make sure that it's taxed as either a C Corp or an S Corporation. Those are the two options you want to choose. Why? Well, you're down here. Yes, this entity here is going to be a dealer. All right, so it will be the dealer. But there's no chance that you'll be treated as a dealer because you're a member or manager of that entity. That's why we're choosing S corporation tax status or C corporation tax status for our LLC or corporation. Now, when we set up this entity, we choose these two tax elections. Many people say, well, which one do I go with, Clint? It really depends on what you're looking for. An S corporation is a flow-through entity. And flow-through means this. If I generated $100,000 in profit inside of my business, after expenses, paying all my contractors, paying out all my ordinary necessary business expenses, that's what's left, that profit. That profit will be taxed to me, even though I leave it inside of the business. Maybe I'm going to roll that $100,000 into my next couple deals. I need it for cash, for inventory, to buy more properties. So even though I don't pull it out, it's still, I will pay tax on it because an S corporation is flow through. That means the income flows to the owners of the company, regardless if they take their funds out. Now, if you take it out at a later date, you're not going to be taxed again. I mean, you only get taxed once on these profits. So the dilemma for some individuals, I have some clients that I work with, I mean, they're really successful in their flipping and they're generating about $100 million a year. And where they're bringing in that type of income from their flipping activities, they don't want that flowing down to them, all that income, because their tax rate's at 37%. They want to be able to cut their taxes, preserve more of that cash that they're generating from the sale of their real estate so they can redeploy it back into more deals. So for those investors, we look at using a C corporation because a C corporation or a C corporation tax treatment, that is going to be taxed at a flat 21%. So just do the numbers here. You're saving 16% in taxes. And on $1 million, that's $160,000 in taxes you don't have to pay because your C corporation is paying the tax. So you take that $160,000 and you go out and you do more deals. So depending on where you're at from a tax standpoint, you may not want the flow-through treatment. You may elect to have the corporation taxed at its flat 21% be the driving force here because you want to retain as much capital as you can at the corporate level so you can do more deals because you need that money to buy additional inventory. Now, for those of you that might be thinking, well, what about double taxation? Well, what about double taxation? Double taxation with corporations, when you net out the numbers, that is, if I made $1 million in 2022, I made $1 million from flipping activities, I pay tax on that $1 million of $210,000, which leaves me with $790K left. When I later pull that money out and take it as a dividend out of my company, I will pay tax at 20%. And so when you add up the tax rates, 20% and 21%, and you average them out, it comes really close to 37%. You may pay an extra 1.5% in taxes overall, but what did you gain by using the C corporation's lower tax bracket? You gain the benefit of keeping $160,000 in your bank account that you didn't have to pay to the IRS that you could use to do more deals. So this is why you want to analyze your business. When you go out and you set up your company to start your flipping business, you want to sit down with someone and go through these numbers and say, what is going to be the best for me as an individual starting this new flipping business? Or maybe you've already been flipping and you're looking to make a change and put together a structure. Okay, so that's the tax angle. Okay, and I'm not going to come back to that. It is what it is. We want to have an entity there that's a C or an S corp that you're a part of, you're the member of, but this isn't where we're going to flip through. Okay, now you probably say, well, he just contradicted himself. He just said we're flipping through a corporation or an LLC tax as a corp. Now he just told me I'm not flipping through there. What's going on with Clint today? Well, the thing is this, we are going to use special purpose entities for our flips. We're not going to flip through our main company here. And the example I'll share with you is just think of it this way. Here's this main company, and this is I'm down here through my flipping company. It doesn't matter how it's taxed. Let's say we set up an LLC for this. And I have a couple of deals going on right now, all right? You sell this deal right here to this buyer. So your company no longer owns it. Now this buyer who just bought this house has an inspection done, and the inspector, the plumber, comes in and looks around the house and says, oh, wow, all this plumbing work wasn't built to code. This is all wrong. We have to redo all of this. And so then you're going to take that and you're going to think to yourself, whoa, I need to redo all this work. How much is that going to cost? And the plumber tells you it's $50,000. Now, if you just spent $200,000 on this house or $400,000 on the house, that's a lot of money, right? You would assume that the work was done to code. Now, there may be some dispute about whether or not it was done to code, but the fact of the matter is this individual buyer here, what are they going to do? They're going to turn around and go after the seller of the property, which happens to be your company. Now, by keeping your other deals, your other properties in the name of this LLC, like we have here, 2 deals that are going on, you really strengthened the buyer's hand. That is the plaintiff in that potential lawsuit. This person right here, they're going to put the screws to you. And there's nothing you're going to be able to do to prevent what they're going to do if they file a lawsuit. Namely this, hey, pay me 50 grand or I'll start a lawsuit. And if I start a lawsuit, I'm going to file a lis pendens on each of these properties. What does that mean? That I'm putting a $50,000 lien on each of your properties. So when you sell your property, I get paid. Well, actually, I don't get paid. It goes to the court registry. If you try to refinance these properties, the money that you take out of that on a cash out refi goes to the court registry. So you're in a position now where the plaintiff has tied up your assets until you resolve this dispute. And why is that? Because these new assets are in the name of the entity that sold the buyer the property. I gave you a real life example of one of our clients who didn't follow the script, the plan that we created for him, and instead he flipped in his entity like I just showed you, and this is exactly what the attorney did to him. And I told him, I said, pay it, try to settle it. Let's get out of it maybe for $35,000. But you're not going to be able to prevent this from going forward. You're going to be stuck in litigation possibly for 2 years if you want to fight it. And if you do lose, not only are you going to lose the $50K, but you're also going to have to pay the other side's most likely attorney's fees as well and your own attorney. So, and you're not covered by insurance on this type of deal. So those people that think, well, just load up on insurance, you're probably not covered. In fact, I 100% guess you would not be covered on this type of claim. So how do we prevent a flipper from falling into this scenario? Well, as I stated, we're going to use special purpose entities. So I will instead create, here's my LLC. So whenever you see the orange box, that's your S or C Corp, that flipping entity that we're talking about, right? S or C. Okay, and you're down here. But this entity doesn't actually own the property. So when we buy real estate, we're going to set up special purpose entities, which would be other limited liability companies. And I'll show you some other entities we could wrap into this as well here in a few minutes. So you're going to set up separate LLCs like this. Now, those LLCs will be 100% owned by your flipping company. They'll be disregarded LLCs, so they don't have to file tax returns. Okay. Now, each of your deals, you'll take one property down per LLC. So in my previous example of having 3 properties, what he should have done, what we outlined for this person, was that you have one LLC set up per property. Then when you sell the property to the buyer, you can shut down this LLC. Just close it down. Close it down. Why? Because when the buyer looks to come back against the seller and they go to and contact the attorney, like if somebody came to me and said, Clint, I bought this house from someone and it's got $50,000 of plumbing work. I want to sue the seller. And I would ask him, well, let me see your purchase and sale agreement. Who'd you buy it from? And I'll jump online. I'll look up the name of the entity. And if I see that that entity is dissolved, what I would tell them is, hey, that seller is out of business. They're no longer in business. So yeah, we could potentially still bring a claim, but we're going to have to figure out where the money went, who the owner of that LLC is. And then it's going to have to survive. The action is going to be subject to a lot of scrutiny and whether or not we have the ability to bring them in, name them as a defendant. So you've just really tripled your costs. So I'll take the case, but it's going to cost you a $20,000 retainer. You see, now that's going to make probably most buyers balk because there's also no guarantee here. I mean, because there's no assets that we can immediately attach. So I like using this strategy. In fact, it was a strategy that my partner and I used when we used to actively flip in the Las Vegas market. We would buy, or we'd set up our LLCs and we put the properties we bought in each individual LLC and then sell the property and dissolve out the limited liability company. Now, assume you don't dissolve it out. Well, so what? Just think of it this way. Now the attorney serves a lawsuit on the LLC that doesn't have any assets. You bring it to me and I'm like, yeah, who cares about this? Just toss it. Why? Because if they sue the LLC, there's no assets there. What are they going to collect? Because at the end of the day, they want to collect on some type of asset. Now, I've been talking about these LLCs, and you might be thinking, all right, Clint, great, I get it's an LLC, but where do I set up the limited liability company? Generally speaking, I would tell you, set up the LLC where the property is located. So if you're actively flipping, for instance, in, I don't know, California, then you would set up California LLC. Well, actually, that's a bad example because I would use statutory trust there. If you were actively flipping in any other state, say Oklahoma, then I would set up an LLC in that state, and I would set up several LLCs, set up multiple limited liability companies, have them ready to go. Don't just set them up when you need them, get a few ready on the shelf. Now, if you flip in multiple states, so you're not just tied to one particular state, I would probably set these up in Wyoming. I'd set them up in Wyoming. Why in Wyoming? A couple reasons why. Number one, we don't know ultimately where we're going to buy the property. Number two, it's really simple, quick, and efficient to get a Wyoming LLC created. And so I would have my LLC set up in Wyoming ready to deploy. Now, the question that oftentimes comes up when I tell people this, and yeah, DL, I see you said Texas. I'll cover that in a moment. There's a little special strategy for you and several other states. The reason I set them up in Wyoming is because just flip through the Wyoming limited liability company. You can do that. You don't need to have it registered. If I was buying a property in Texas, I could own it through a Wyoming LLC. There's no problem with me structuring it that way. And I've dealt with plenty of title companies where my clients will contact me and they'll say, well, the title company tells me that this LLC needs to be registered in, the last one I dealt with was Florida. I said, that's BS. Why does it have to be registered in Florida? So we got the title company on the line and I just started going through it with the officer. Why? Well, he's doing business there. Well, that's his issue, not yours. So tell me why we can't close in the LLC. Well, it's supposed to if it's doing business there. I said, again, you're making assumptions here about the law that you don't know about, and this isn't your issue. Your issue is to ensure that we have a clean title that records into the name of the LLC, and where that LLC is formed is irrelevant. Are you telling me an out-of-state resident can't own property in Florida? She said, no. Well, then this is what the LLC is, an out-of-state resident entity owning property in Florida. And we got the deal done, but those are some of the challenges you may run into. And if it just becomes totally insurmountable for you, then you just register that entity as a foreign entity in that particular state where the flip is taking place. So I've done a lot of these types of structures for people where we'll set up Wyoming LLCs for them. We call them shelf LLCs. They're sitting on their shelf and they're ready to deploy. They've already got some names associated with them. And then when they find the deal, they just take the deal down in that existing limited liability company they already have. Now, there are some nuances to this type of planning. DL's from Texas, and one of the, DL, what you're thinking there is, would you use this same strategy in Texas? I would not use this strategy in Texas or any other state that I might be flipping in that has adopted a series LLC. Now, I say that and keep in mind that whenever I tell you something like this, it's not 100% of the time. It's not a one-size-fits-all, because there are some series states that when you're setting up a cell, it may be more complicated. It may be better just to go with a traditional LLC over a cell agreement. But generally speaking, if this were a Texas individual, you could set it up as follows. Set up your series LLC right here. This is what we call the parent LLC. And then elect to treat it as either an S or C corporation for tax purposes. Okay. Now I'm going to create separate cells for each of my flips. So these are the cells that I'm setting up. And those cells are 100% owned by the parent limited liability company. So if you're flipping real estate in a state that recognizes the series type structure, then rather than using this example here where I'm setting up the LLC, okay, so if this was Maryland, this would be a Maryland limited liability company. Here, either a Wyoming or Maryland LLC here. So you can see I've got 4 LLCs that I set up. Whereas if I'm doing this deal over here in Texas, there's only 1 LLC that I had to set up, and each of the other cells are just those separate operating agreements. Are typically 4 pages. You just set up, you come up with a name, you sign it, and you're good to go. And you go out and you take title in the name of that cell. And then when you're done, you just shut the cell down. And again, you do it yourself. There isn't anything that typically has to be filed with the Secretary of State. In Texas, for each of your cells, you do have to file a DBA with the state of Texas. So that does get registered. I think it's $10 to do it. It takes about 4 minutes in order to register the cell. But that's how I would run it if I'm in a series state. And as far as closing, one of the companies that I'm most familiar with in Texas that has title companies that work with series LLCs is Capital Title. So DL, I'll give you a lot there to chew on when it comes to flipping real estate in Texas. Now, another concern you may have, this assumes that for most of you, you're finding your deals and you're going through a traditional process of putting them under contract, then you're closing, either bringing in a HML to close on that deal, or else you're just buying for cash. So this sets up nice. Now, what happens if you're not buying for cash or using an HML, the traditional route? Maybe you're buying at auction. So would I use this same type of structure if I wanted to go to auction? Well, you could use a series LLC if you want to buy at auction, but another way that I've dealt with this before is I like to use land trusts. So I have clients that we set up land trusts for. These are these documents here. What I'll do is I will create a short land trust, short form trust agreement is how I just refer to it. And it's typically a 2-page land trust. It gives the basic information that you need to have a land trust set up. So, the client's listed here as the trustee, or typically what we use in this scenario is actually an entity. So we'll have an LLC set up over here, a separate LLC, not their flipping entity. This is just a trustee LLC. Let's refer to it as that. We'll have a trustee LLC here, and then the client will be the beneficiary of the trust. Now, why do I do this for the auction buyer? Because when you go to auction, you don't know what you're going to get. And many times you may want to take title to that property in the name of an entity that incorporates some aspect of that title in the entity name. So if I bought the property on 732 Broadway, I might call it the 732 Trust. And if you're using LLCs, it makes it more difficult to plan because you don't know what property you're going to buy at auction. So you've set up 1465 LLC, but it owns a 732 Broadway property. That can get confusing for some people. So what we typically will do then is we'll go to auction with this short form trust agreement, 2-page trust agreement. You just sit there with a stack of them. You haven't filled them out yet. It has you listed as a beneficiary, has your LLC listed as a trustee, and all you're waiting to do is win the bid. You get that property. As soon as you get the property, you know the address, you just fill it in, sign it, and that's how you go and you take title in the name of that trust. Now, once you get that trust set up and it's holding the property, then we take that trust and we'll just incorporate it back over here, make the beneficiary a cell, something like that, or maybe using the separate LLC structure. We'll bring that back into the separate LLC. But it's one way in which we can expedite that closing process for ourselves when we're buying at auction, because we just fill these out as we need them, because unlike an LLC, it doesn't have to be registered anywhere. So the land trust, I think, can be a very valuable tool for anyone who wants to flip property and they're buying at auction. So I would look at using that. Now, if you're buying and say you're going to close on a flip and you're using some traditional funding, qualified mortgages, something like that, to flip a property. So you're coming in at 25% down on your deal, and then you would deed the property in at a later date. That works. But just remember, you've heard me talk about this a lot. If you buy the property in your own name right here and you plan to flip it and there's debt on it, if you live in Florida, then you want to make sure you're using a land trust for your deal. Okay, so make sure if you live in Florida, you're going to use a land trust, because you don't want to transfer this property directly into a limited liability company, because if you do, you're going to have to pay a dock stamp there. So the land trust in Florida is the way to go for flips. And the nice thing about Florida is that the land trust provides asset protection. So if I was flipping in Florida, I would set up a structure as follows. I create an LLC, treat it as an S or C corp for tax purposes, and I would just use land trusts for all my deals. I have a lot of clients in Florida clients, that this is the option that they've opted for, because then they don't have to go through the expense of creating multiple limited liability companies and closing them down. They just use a land trust and then shut it down. Now, the drawback, of course, to using the strategy of using the land trust alone is that it only works in Florida, right? It doesn't work in the other states. That is, other than Florida, you cannot obtain asset protections for a land trust. Let's say one I used in Texas. That example there, if I set up a land trust because I'm buying an auction in Texas, I don't want to save the beneficiary. I want to make sure I get that into an LLC or a cell. So if something goes wrong, then they sue the land trust, and then that would come down here to that cell, and I'm protected. In Florida, you don't have to worry about it because they have a statute that provides protection with them. Now, how about if you're buying land? DL wants to know, does that cause any additional restrictions or any complications when I'm buying land? Not at all. It's not difficult with buying land. You can do the exact same thing with land. Now, how about if you're in California? So let's say that you want to invest in California. Would my rationale change on how I would structure this? Well, in California, every time you create an entity, it's $800, right, to the state of California. So if you want to look at some cost savings, then I would probably recommend, and I have several clients doing this, set up a Wyoming Statutory Trust, a WST, and flip through the Wyoming Statutory Trust. Set it up. It's not subject to $800 franchise fee because it's exempt. And then these entities, of course, would all be owned by your flipping company. Now, this flipping company here, this would be California. So your flipping company is always going to be in the state where you're located. Okay, so that's how I would structure it if I was California. If you wanted to save on those $800 franchise fees that would apply. Now, the one thing that you don't really get with this structure, the way I've been describing it, is anonymity. Okay, because most of the time when you're putting these things together, let me show you this other example here. If I have my parent company here and I have an LLC like this and it's owned by my corp, maybe you're listed as the manager of this LLC and your corp's listed as the member of the LLC. So if anybody looked and they start digging into this company here, they're going to see your name listed there as a manager. And they're going to see the corporation possibly listed as the member, of which, you're an officer or director, or you're the manager of that. So they're going to know, you're all involved in this and how to find you. They'll just skip trace you. So if you're looking for anonymity, you don't want people to know how to track these entities back to you. Because I've had clients that have fallen into this situation before where they've got into not problems, but buyers tried to create problems for them by making baseless claims and threats to destroy them on social media. And so what they did is they came to me looking for a way to minimize their footprint. That is, they don't want some buyer to know that they're involved with these entities. So how did we do that? What we did is we take again, here's the parent company. This is the tax entity. This is where all the income flows through. We took that entity and we set up a Wyoming LLC that was 100% owned by the parent entity. And then when we created the other entities, say this one here is a North Carolina LLC. And then we set up a South Carolina limited liability company for a different flip. And maybe we're also flipping in Oklahoma. So in Oklahoma, because it's a series state, we create an Oklahoma series LLC like this, run it down here. And then we have cells rolling back up into here. Now, why did I use this type of planning here? Why did I bring in this additional entity that I haven't talked about before? It's because when we set up these upper tier entities, if we don't have the blue box in our plan, everything points to the orange box and your name's on the orange box. So what I wanted to do was create a scenario where if somebody looked at these upper tier entities here, the red boxes, that they wouldn't see the orange box. I wanted to point these red boxes to an entity that doesn't collect any information on its members or managers. And if you heard in a lot of my videos, I talk about the benefits of Wyoming. That is one of the key benefits, that you can set up a Wyoming LLC, you're the manager, you're the member, or whoever's a member, it doesn't matter. None of that information is disclosed on the Secretary of State's website. So we opted to go then with this Wyoming LLC that's disregarded, okay, so it doesn't file a tax return. All the income flows through these and it's taxed right here at this entity. We set up the Wyoming LLC to serve as a buffer to create anonymity. So whenever we created these upper tier entities on the filings, when I submit it to North Carolina, what type of LLC do you want to form? I want to form a member managed limited liability company. Okay, who's going to be the member of this North Carolina LLC? Blue box out of Wyoming is the member. So now if somebody buys a house from this client's LLC and they're not happy with their purchase and they want to go back against the seller, they look up the LLC, it's going to point them to the Wyoming Limited Liability Company, and from there, it's a dead end. They don't know who else is behind it because that information is not disclosed, because that Wyoming LLC serves as a buffer. So that's why if you're looking for anonymity, you may want to consider using that Wyoming component there. Now, some people might think, well, why not just don't do this, just set up a Wyoming Limited Liability Company to begin with? Well, the reason why you just don't set up a Wyoming LLC to begin with is because if you lived in New Mexico and that's where you're conducting your business, this entity is going to have to be filed there. And so when you go to file it in that state, now you're filed in Wyoming, New Mexico, and if your state requires you to list information about yourself, even though Wyoming didn't, your state may require you to list this information about your entity and who's in control. You're going to lose your anonymity shield. So the only way the anonymity shield holds is long as this entity here stays in Wyoming. And there are other states out there, Delaware, that doesn't collect information that you could use in addition with your planning. All right, so I got a question here that's come in. If a foreign developer wants to set up a joint venture with landowner to develop 420 multifamily unit, looks like there's a two-part to this. For the development LLC, is it more reasonable than a corporation regarding taxes for the assets of the foreign investors? Okay. So the problem with this question and responding to it is that you want to look at the treaties, tax treaties, and know for the foreign investor how the income they derive from the U.S. is going to be taxed in their home country. Many times what will happen is when you're investing, say you're going to do a deal here in the U.S., they'll create an LLC, and then this LLC will be owned by a blocker entity here. This is for the foreigner. So they have a foreign entity that's set up as a blocker entity, and then from there it goes down to maybe another entity or a person, and all this is driven by taxation to ensure that whatever revenue is generated on the U.S. side, that it's minimizing the taxes as they flow back to the foreign investor. And so you really need to work with someone who is well-versed in international taxation with that particular country, so they can tell you what is the best structure to set up to ensure that we're minimizing the taxes for the foreign investor. All right. So For flipping then, it really comes down to you're going to end up using a lot of entities in your overall planning. You set them up, you flip out of the deal, and then you shut them down. One of the things that I often tell people, if you're using land trusts, okay, and you've got a structure that land trust goes into an LLC and that goes into an entity, I like to set these up where the land trust and the LLC have the same name if possible, if you can do it this way. So if this LLC here is 732 LLC, call this the 732 Trust. And the reason why I like to keep the names similar or exactly the same, with the exception of the designation LLC, is so that when you close, where you sell your property and escrow pays out, you get your money, it's sent typically to the name. Title company's going to send it to the name of the trust. They won't send it to the LLC. So then you got this check or that you're holding on to. And I always ask for checks in this scenario. I don't ask them to wire it, because to get a wire, you have to have an account opened up. And I will not open up accounts for the trust. I'll have an account opened up for this limited liability company here to collect the proceeds. So I get that check made out the 732 Trust. I'll go down to the bank where I've set up my account for 732 LLC. And I'll just walk in. I'll say, hey, title screwed up. They issued it to 732 Trust. It's really an LLC. Can I negotiate it? And they'll just, I've never had a problem with this. They'll deposit the check into the LLC account. Now, if you didn't do this, and let's say this is the 1865 Trust, and this is the 732 LLC. The second strategy I use to solve this issue when I've sold a property is I will then file a DBA for 732 LLC as the 1865 Trust. So now I can go to the bank and say, yeah, my 732 LLC is doing business as the 1865 Trust, and I got $65,000 I need to deposit. So I give them both to them, and they deposit it into my account. So one way or another, I get what I need done, and the proceeds flow in. But it's much easier as long as you're keeping the names the same when you're putting these entities together. All right, I think we pretty much covered everything there is to know about flipping and creating entities. It's not that difficult. The only thing you need to be aware of as well, as I talked about installment sales, where if you have a corporation, so here's your entity, your flipping entity again, and here's my LLC, and here's the house. If you sell this house on an installment sale, remember, let's say that you bought it, or you're all into it for $65,000. That's your basis, and you sell it for $100K. That's a fair market value. You will pay tax on that $35,000. It doesn't matter if it's held by this corporation, through the LLC, or it's you individually. You still got to recognize that income the year of sale. So if you know that you're going to be working with buyers who are going to be buying on contract from you, typically you're going to help homeowners that have a little bit of damaged credit get into the property, and then you're going to seller finance, and then they're going to turn around after 2 years and refi that deal out and go with traditional financing, and you're going to get paid off. Well, you may want to consider in that case making sure that you've set up this base entity here as a C corporation. So when this $35,000 tax hit rolls in, it's taxed at 21% versus whatever your individual rate is. I mean, if you're under 21%, great, cool, keep it that way. But if you're over 21%, let's say you're at a 30% tax rate, well, that can get expensive because you're paying taxes on money you haven't even collected yet. So that's how I would likely set it up. All right. So what is the best way for a developer to transfer the land to a foreign developer for the investor to purchase 50% of the current owner's LLC share? Well, if I'm not sure how best to do that. If I was bringing in a foreign investor or developer into the deal, I would be looking to either structure it as bringing them into the LLC, selling them a 50% interest in the LLC, setting it up. I mean, you could do this. If you already had it, let's say you had the land in an LLC right here, and you've got this foreign developer over here that's going to come into this deal. You could set up a special purpose JV LLC with foreign developer and you, and just put your LLC into there. That's one way you could structure the deal. The other way you could do it, a little more risky here, is you could have foreign developer come into this parcel of land, of which the developer, let's say you're going to give them 50%, they would own 50% as a tenant in common, and your LLC here would own its 50% as the other tenant. And then you would file a tenant in common agreement. You have a TIC agreement recorded with the property to let any person that's curious about what's going on with this asset, who's in control, how profits, who the owners are, how profits are to be divided, things like that, in the event of sale. So that would be a second way in which you could run that deal with the foreign developer. All right, so how do I send you money while you are alive? You don't send me money, so there's no way for you to do it. Although I appreciate the gesture, that's not what we're here for. We're here just to give you education. And be sure to, if you want to learn more, this week, I'm going to be teaching an event on Saturday. It's going to be a one-day event, tax and asset protection for real estate investors. You can go to my website, andersonadvisors.com. If you go there, you can look at our events. You can register for it. It's free to register. We're going to be going through different asset protection techniques. I'll be talking about flipping, talking about short-term rentals, long-term rentals, commercial real estate. And then in the afternoon, my partner Toby Mathis will come on and he will discuss tax planning for those real estate investments. And I saw somebody, it's actually, we put a link here as well in the chat comments. You can see that link. It's in there. You can just click on it and get registered. But we'll be covering things like 1031 exchanges, bonus depreciation, cost seg. We'll be going into that and show you how you can reduce taxes on your real estate investing. And we just popped that again. All right. So my understanding is, check this out right here. My understanding is we may need to register with the state where the property is located, only if you sell more than one property a year in that state. Okay. If there is a single transaction in the year, then there's no need to register in the state. Please clarify. All right. So what your question really goes to is back to, if you're following this strategy, here's your LLC that's going to own the actual property like this. And let's say this deal's in Oregon. And that LLC in turn is owned by your company, your corp that you've set up. Now, the entity that needs to be registered in the state is going to be the entity that actually owns the property. Now, in my example, literally, you don't have to use an Oregon LLC. You could use a Wyoming limited liability company. You could use Wyoming LLCs for all of your deals. And I have a lot of clients that flip exclusively through Wyoming limited liability companies. They're titanium clients. They call me up and they say, hey, Clint, I need another LLC, And we're just generating these Wyoming limited liability companies for them for their flip deals. And their flip deals are taking place in multiple states. Now, let's say in Oregon, I'm doing 8 deals this year. Well, do I need to register anything in Oregon? No, because I'm doing 8 deals through 8 separate LLCs. It's only when I take one LLC and I do 8 deals through it, then that LLC is going to have to be registered there. But if I'm only doing 1 deal per LLC and shutting it down, then it hasn't risen yet to the level of having continuous contact with that state, regular and continuous contact with that state that would necessitate a foreign filing into the state of Oregon. So this is how, when we're setting up structures, we work around the specific state filings. We just say do 1 independent deal through there and then move on, because you're going to create another limited liability company. All right. Now, any other questions regarding the structures and how this works, or just about real estate in general, just go ahead and pop that up there. Be happy to answer them. DL, you stated, what do you put on there? You've monetized your channel with advertisers to get super chats through YouTube. This is because the other person want to send you money. Oh, I don't know if I've monetized my channel to get super chats. I'm not familiar with that and how that works. This is more of one of those things I just, I like doing it, like sharing the information. And, we do generate clients, of course, because we do set up entities. And that's why I encourage people to come to the one-day events when I teach those. So it gives you a deeper understanding of what it is you should be doing. And then you become more educated. So you become a better client to work with, because we now operate with the same terminology, and there's a base understanding of the why. Because I've talked to many people before. They come to me and they show me a structure, and it's held by this and that's held by this, and I say, why did you do this? I couldn't tell you. Hell if I know. They just said that's what I need. Well, what does it do? I don't even know that. That's why I'm here. I need help. So we want to make sure you don't fall into that category. And so getting the education is really it's a big part of what Anderson does with our clientele. Okay, so if you buy property in Florida in an auction using cash and get title in the Wyoming LLC name and then sell it, do I still have to pay dock stamps in Florida? No, you don't have to pay dock stamps in Florida if you close for cash in your own name because you bought it for cash. There's no debt on the property, or if you close in an LLC. Dock stamps only come up when you're taking encumbered real estate that you own. This is my only concern, not about when you sell the property, whatever the taxes are going to be, but when you own it and you're transferring your debt encumbered real estate into a limited liability company, that's when you're going to run into some problems there in Florida. So that's why we use a land trust, to avoid that. All right, how would you receive tenant payments from Florida properties with a Wyoming limited liability company? Well, if you have a tenant in Florida, that's different than a flip. Because remember I said it's regular and continuous. So if I had rental real estate in Florida, this is my rental real estate, I would probably have that in a land trust, or it could be in a limited liability company. And if it was in Florida in a land trust, then unlike other examples, I would have a bank account opened up for this entity, and I would receive the payments directly into the trust. That's how I would probably do it. Now, there's other ways to do this as well, to structure it, but I'd have that trust owned by a Wyoming limited liability company. And remember, those payments, how are they coming in? Are you self-managing, or are you getting an owner statement every month? Because they're professionally managed. And so, when we receive our owner statements, it's just, they send over a spreadsheet, all the properties, breaks down all the CapEx associated with those deals for the month, and the vacancies, and how much rent we collected. We get one wire, and that one wire goes into one account that collects the funds. So it really depends. That's why I would suggest that you have a strategy session with us, so we can look at and analyze your scenario and see what would be the best for you. Can you give me a baseline of how to operate completely anonymous in Texas from start to finish? Yeah, so it's real simple. If you want to be anonymous in Texas with your business entity, then you start with a Wyoming LLC here, or Delaware. So that's the first entity you create. And then you set up a business entity in Texas. So this would be a Texas LLC. That's either going to be an S or C Corp. That assumes you're running a business, okay? And then you have it owned 100% by this Wyoming LLC, which is the sole member of the Texas LLC. So that's one way to do it, and this one would be disregarded down here. That means it doesn't have to file a tax return. Another way, if you weren't considered to run an active business and you're just setting up rental real estate the way we do it, is we'll create a Texas series, and that's owned 100% by the Wyoming LLC, and then we create the cells like that. That's how we do it in Texas, to give our clients 100% anonymity. All right. If I'm in Mass and I have a Wyoming Holding Company, Wyoming LLC. I'm missing a few things here. A multiple M. I'm not sure what you're asking there. All right. What is the earliest way with all the changes? What is the? I'm not sure, David, what you're getting at when you say what is the easiest way, maybe with all the changes. I mean, everything that you do with real estate when it comes to structure, it's not a one size fits all. So that's why I encourage people that come to my channel to sign up for a free strategy session. You know, it's all over my channel. It's in the show notes on every video. You can sign up for a free strategy session, and we'll look at your individual situation so we can put something together that really makes sense for what it is you're doing. The entity in Wyoming, will it be manager managed or member managed? The entity in Wyoming will always be manager managed. We'll set that blue box up as a manager managed, or even if it's in any type of LLC that we're creating. As long as we're not filing in another state, it's going to be manager managed by you. If we have to file it in another state, then we will set it up as a member managed LLC, presumably by a different Wyoming LLC that would be manager managed. All right. Have you heard anything about people who live in California and try to form an LLC in another state and they're subject to get in trouble? I keep hearing rumors about that. Yeah, what they're talking about there is that if I live in California, so I'm here, and I set up a Wyoming LLC over here in this state, and I'm the member of that, this LLC here must pay $800 each year to the state of California because the California resident is a member of that company or even a manager. So the way we get around that is we then choose to set up entities that aren't subject to that franchise fee of $800. And that's why I recommended the Wyoming Statutory Trust as an alternative. Now, if you have a logistics LLC and you wanted some help with structuring that, we could talk about that. But if you live in California, then unfortunately, you're running the LLC, if you're running the business out of California, it's going to have to be registered in California. But if you you still want to have it registered in California, but you want anonymity, understand that comes with a cost. And not just, attorney's fees, nothing wrong with that, but what happens is that you set up a Wyoming LLC, and then from there, you would form your logistics in California as a California LLC over here. And so when people look at the California LLC, it's going to point them to the Wyoming LLC, of which you're the owner of, and no one's going to see you there. But I oftentimes tell people when you're running an active business and you're dealing with the public, they're going to get some sense that this is possibly your company because depending on your business cards, how they read or how you hold yourself out, they're going to know it. So even if you go through this type of structuring to mask your identity, remember you're still the one running the business, and that could still flow back up onto you. And the other thing about active businesses and anonymity, when you're running a logistics business or some other type of company, outside of real estate where it's dependent upon interactions with the public trying to put deals together, sometimes anonymity is not going to be your friend. And I would shy away from it because, just think if somebody asks you, well, who is the owner of this company? None of your damn business. Oh, and you want me to enter into an agreement with you? Yeah. Well, who am I entering into agreement with? The company. Well, who operates the company? None of your damn business. And you hand out business cards with a big question mark on them, right? That's not going to help you move ahead with that business probably. So if it's active, I would probably say keep it in your name, and go from there. All right. You're in Indianapolis. All right. So if you're in Indianapolis, really, you're not going to have $800 there a year in Indianapolis. You don't have that franchise tax in California. But if you're doing business in California, you're going to have to register there, and then that can bring it in. But yeah, it'd be a good one to talk about in your situation. Maybe sign up for that strategy session, and we could explore it. But if your fiance is in California and you're in Indianapolis, wow, that's a lot of travel back and forth. Here's the thing. Don't put her on the entity. Keep her off the entity, or at least you can put her on, but don't put her on as a member. Put her on as an officer, something like that is how I would do it. But don't list her as a member in the company. I got time for one more question here. If we create a Wyoming holding LLC that owns multiple Massachusetts LLCs, should all the profits flow through the Wyoming LLC and I get paid and pay my taxes from that LLC? So yes, the answer to that is you would flow everything through your Wyoming LLC. And again, this depends on how it's structured from a tax standpoint. It all flows through here down to you, and then you pay taxes here on your individual rate. Now, if this Wyoming LLC was set up as a C Corp, well, of course, it would pay taxes at its 21% rate. But yes, you're exactly right. That's how the federal taxes work with these flow-through entities. It all trickles down and lands in your pocket. All right, one more question. What is the best entity to open a U.S. stock trading account with a brokerage firm? Typically, we use a Wyoming LLC for that. So that's what I would do. Yeah, if you want to reach out to us, talk about JV LLCs, standard LLCs, go ahead and click on the links that we've provided in order to go to andersonadvisors.com, set up a strategy session on my YouTube channel. Any of my videos, strategy session link is in there, just in the show notes. You can check that out. If you haven't done so already, make sure you subscribe to the channel. Become a member so you get notified once you subscribe. Whenever I create new content, I try to create new content. I'm putting up new content on Mondays and Thursdays every week. And I got a lot of interviews in store for you coming up with some really great individuals who have been doing a lot in the real estate realm that you're going to learn a lot from when it comes to lending, when it comes to wholesaling, flipping real estate, buying long-term, commercial, that types of stuff. So got a lot of things coming for you. Guys, thanks for joining me today. I really appreciate it. Be sure to check out also, when you become a subscriber, we'll be having these, my upcoming events, live events like this, where you can bring your questions to it, and we'll be posting those topics in the next few days. All right, everyone, take care. Thanks for being there.